Now the next topic is retirement of a partner. Retirement of a partner comes under the reconstitution of partnership firm. Under the reconstitution of partnership firm, we have already covered change in profit sharing ratio and admission of a partner. The third one is retirement of a partner. The partner of a firm may retire. For that, the partner has to give his consent or information to the firm well in advance as per the terms and condition drafted by the consent of all partners in the partnership firm. Okay, as per the terms and condition, rules and regulation drafted by the consent of all partners in the partnership firm, to that rules and regulation, at the time of retirement of a partner, the retiring partner have to give his consent to the other partner or to the firm well in time, and the partner may leave the firm. Okay, so when the partner leave the firm, it means at the time of retiring of a partner, suppose A, B and C are partners. Their profit sharing ratio is 2:1. Here suppose A want to retire from the firm. He want to leave the firm, or he is going to retire the firm. So after his retirement, when this partner retire the firm, the partnership will dissolve. When the partner retire from the firm, partnership will dissolve, but partnership firm will continue the business. Partnership firm will continue, but partnership will dissolve. The partnership agreement between them are dissolved, but partnership firm may continue. So partnership firm after his retirement continue by B and C. At what ratio they will decide? Okay, at what ratio they will decide, and his share of profit will be taken by whom? When the A retire, his share of profit is how much? 2/5. So 2/5 share of profit is taken by whom? B and C. Only B, only C. If both of them are taking the shares, then at what ratio? In the ratio of 2:1, or in other ratio, or 1:1. So we have to see. So the new partnership firm, in the new partnership firm, now B or C will continue the firm. With the new agreement, maybe the new ratio will be as per their decision. It may be 3:2. So when the partner retire, the partnership will dissolve, but partnership firm will carry, or partnership firm will continue. Okay, so at the time of retirement of a partner, we prepare we follow the certain steps. Number one step is find out the new ratio after the retirement. New ratio after the retirement. Second, we have to see the gaining ratio after the retirement. Who is the gainer and who has sacrificed? Gaining and sacrificing. We have to calculate gaining and sacrificing ratio. Third, we have to do the valuation of goodwill, new valuation of goodwill, and thereafter we have to do the accounting treatment of goodwill, Thereafter we have to see accounting treatment of past accumulated profit profit and loss debit balance, credit balance, profit and loss account debit balance, fictitious assets, deferred revenue expenditure, okay. Treatment of workman compensation reserve, treatment of investment fluctuation fund, thereafter we will prepare revaluation account. Revaluation account will be prepared in the same pattern, in the same way as we have discussed in the chapter admission of a partner. If the assets value will increase, this will be in the credit side of the revaluation account. If the assets value will decrease, then in the debit side of the revaluation account with the difference amount. Vice versa, if the liability will increase, then debit side, then liability will decrease, then credit side, because it's an income. Unrecorded assets credit side, unrecorded liability will be shown in the debit side, and if there will be any profit or loss on revaluation, will be transferred to all partners capital account including the retiring partners. Okay, between their old ratio, between the retiring part, including retiring partners in their old ratio. So revaluation account will be prepared in the same pattern. Thereafter we will prepare partners capital account, including the retiring partners capital, including retiring partners account. And 8 number is your revised balance sheet, new balance sheet. After all adjustment, we will prepare the revised balance sheet. So these are the things we will do it at the time of retirement. We will find out the new ratio, gaining and sacrificing, valuation of goodwill, accounting treatment of goodwill, and we have to know the accounting treatment of past adjustment profit, past accumulated profit, profit and loss credit balance if any in the balance sheet, profit and loss debit balance, fictitious asset, deferred revenue expenditure, workman compensation reserve, investment fluctuation fund. In the same way as we have done the treatment at the time of admission of a partner, in admission of a partner, these things are not transferred in the old partners and new partners capital account, but here this will be transferred or adjusted in all partners capital account including the retiring partners. In case of admission, it is only transferred to the old partners capital account, not in the capital account of the new partner. But in case of retirement or death of a partner, this amount will be transferred to all partners capital account, means including the retiring partners as well in their old ratio. We will prepare the revaluation account in the same pattern, but only difference is this profit on loss or revaluation will be transferred to all partners capital account. In case of admission, it is transferred to old partner only, but here all partner, means including the retiring partners in their old ratio. Partners capital account will be prepared so that we will know the new capital balance, and here the partner who is going to retire, we will not find the capital balance of that partner. We will pay the amount to that partners, will pay the compensation to that partner, or if the firm has not paid the amount, then that amount will be retiring partners balance amount will be transferred to his loan account. Either the amount will be paid to the retiring partners, or if not, then the entire amount will be transferred to his loan account, or it may be some part is paid or some part is not paid. So the amount which is paid then to cash account, amount which is not paid will be transferred to his loan account, but we will not find out the balance of that partner's capital account. We will find out the balance of only those partners capital account who is continuing partners capital account balance will be find out, but retiring partners balance will not be find out. That amount will be transferred through the payment. Will pay the amount, or that amount will be transferred to loan account, or maybe both. Some part is paid then to cash or to bank, rest part which is not paid to transfer to his loan account. Then revised balance sheet will be prepared. Okay, we'll see the question one by one. From the first two, new ratio and gaining ratio. New ratio and gaining ratio. This will cover new ratio and gaining ratio. Okay. So the question is, note down the question, please. You note down the question. Okay. A, B and C are partner in a firm sharing profits and losses as 7 by 15, 1 by 3rd and 1 by 5 respectively. A, B and C, A, B and C are partners. Their profit sharing ratio is 7 by 15, 1 by 3rd and 1 by 5. First of all, we'll make the profit by making the denominators equal so that we understand it. So if denominator is 15, I try to make the denominators equal of all the partners. So I multiplied accordingly. So it is 7 by 15, it is 5 by 15 and it is 3 by 15. So the old ratio between them is 7:5:3, you can say. Okay, I have converted it. Thereafter B retire. He is going to retire. He retire. And his share is taken by A and C. His share means 5 by 10 share. 5 by 10, 12, 5 by 15. 5 by 15 share is taken by A and C in which ratio? 3:2. In the ratio of 3:2. So we will find out the 3:2. Okay. So A's gain over here is how much? A's gain is, his share is 5 by 15. So this share is taken by A and C in the ratio of 3:2, 3 by 5, and C's gain will be 5 by 15 into 2 by 5, 3:2. So it is 15 by 75 and it is 10 by 75. Yes, 10 by 75. Yes, 10 by 75. So the new ratio will be old ratio plus gaining ratio. So whereas A's ratio is concerned, old ratio of A is 7/15 and he is the gainer by 15/75. So LCM is 75. 50/75. Okay. What about C? C's old ratio is 3/15 and gain is 10/75. So 75 25/75. So 75 is common in between them. So new ratio between A and C is 50 into 25 means 2:1. 2:1 is the new ratio. Is it clear? 2:1 is the new ratio. After that, D is admitted for 1/3 share in the profit. Thereafter D is admitted. Admission of D into the new firm. Admission of D into the new firm for 1/3 share of profit. 1/3 share of profit. Okay. And 1/4 of which was given by A. 1/3 out of this 1/3, 1/4 is given by A. So A's sacrifice here is 1/3 into 1/4, 1/12 is sacrificed by A. So remaining share after A's sacrifice, remaining share is what? Remaining share is out of 1, okay, out of 1, out of total 1/3 share minus 1/4. So remaining share is 3/4. 3/4 share left. Okay, 3/4 share is left. No, remaining share is 1/3 minus 1/12. It is 4 minus 1. 3/12 is the remaining share. 3/12 is the remaining share of whom? Of D. And this share is, remaining share is taken equally by A and C. A's sacrifice, A again sacrifice, and C's sacrifice 3/4, 3/12 into in equally 1/2 and 1/2. So it is 3/24 and 3/24. 3/24 means 1/8 and 1/8. Now the new ratio after D's admission, new ratio after D's admission will be come to A's new ratio after, this is the new ratio after B's retirement. Okay, so new ratio will be old ratio minus sacrificing ratio. So come to A, old ratio is 2/3 and sacrificing by A has sacrificed 1/12 here and 1/8 here. So 2 by third minus, what will be the LCM? What will be the LCM? 24. 24. So 2 plus 3. So 2 by 3 minus 5 by 24. So 24. 11 by 24. So A's new ratio is 11 by 24. Is it clear? 11 by 24. Now come to C's new ratio will be, this ratio is 1 by 3 after retirement of B, minus his gain is, his sacrificing is 1 by 8. 1 by 8. So LCM is 24. 8 minus 1, 7 by 24. 7 by 24. 1 minus 1 by third. Sorry. 5 by 24. So the new ratio is, after D's admission, 11 by 24, 5 by 24, and D's share is how much? D's share is 1/3. So we'll make the denominator equal. So new ratio is 11:5:8 after D's admission. 11:5:8 after D's admission. This is the ratio after B's retirement between A and C, and this is the ratio after D's admission. So this is for A, this is for C, and this is for D. New ratio is 11:5:8. Now see the next question of new ratio and gaining ratio. P, Q and R, P, Q, R and S are partners. P, Q, R and S are partners. Profit sharing ratio 2:3:5:2. Okay. S retire. This partner is going to retire, leave the firm. S retire. His share is equally acquired by Q and R. His share means his share is acquired by Q and R in the ratio of 3:2. His share is acquired by these two partner in the ratio of 3:2. Q and R in the ratio of 3:2. Calculate the new ratio and gaining ratio. So his share is how much? S share is 5, 2, 3, 5, 5, 10, 12, 2 by 12. So Q's gain is 2 by 12. It's the share of S into 3 by 5, and R's gain will be 2 by 12 into 2 by 5. So it is 6 by 60 and 4 by 60. This is the gain. New ratio will be old ratio plus gaining. So come to the P. P's old ratio is 2 by 12 and he is gaining nothing. So his new ratio will be as it is 2 by 12. Okay, 2 by 12. Come to the another partner Q. Q's old ratio is 3 by 12 and his gaining is how much? 6 by 60. So LCM is 60, 15 plus 6, 21 by 60. R old ratio is 5 by 12 plus gaining is R's gain is 4 by 60. LCM is 60, 29 by 60. So new ratio is P 2 by 12, P, Q 21 by 60 and R 29 by 60. I am going to make the denominator equal 60 of all multiplied to 5 both end. So it is 10 by 60, 21 by 60, 29 by 60. So the new ratio is 10 is to 21 is to 29. 10 is to 21 is to 29. And the gaining ratio is this. You see the gaining ratio. Denominator is same, so 6 is to 4 between Q and R. Only Q and R is the gainer. It means 3 is to 2. 3 is to 2 is the gaining ratio. Okay. Now see the next question related to the same new ratio and gaining ratio. So question is, A, B and C were partners sharing profit in the ratio of 3 by 8, 1 by 2 and 1 by 8. A retires and surrenders 2/3 of his share in favor of B and remaining in favor of C. Calculate new ratio and gaining ratio. So question is, A, B and C are partners. In between them profit sharing ratio is 3 by 8, 1 by 2 and 1 by 8. When the ratio is given like this, we just do this ratio so that we present this ratio in this way so that other will understand. So we will make the denominator equal of all the three. Here is the 8. I want to make the denominator 8 of this ratio of B. So it is 3 by 8, 4 by 8 and 1 by 8. So you can say that the old ratio, now it is easy to understand, 3 is to 4 is to 1, old ratio. Here A is going to retire. His share is how much? 3 by 8. And he surrendered 2/3 of his share in favor of B. So B's gain will be 3 by 8 share. Out of the 3 8 share, he surrendered 2/3 from his share. 2/3 means 6 by 24. So remaining C's gain will be 3 by 8 into 1 by 3, 3 by 24. So the new ratio will be old ratio plus gaining ratio. So come to the B. B's old ratio is 4 by 8 plus gaining is 6 by 24. 6 by 24. So LCM is 24. 12 plus 6, 18 by 24. Okay. C's old ratio is 1 by 8 and gain is 3 by 24. LCM is 24. 3 plus 3, 6 by 24. So the new ratio is 18 is to 6. You can say 6 is to 1. 3 is to 1. 3 is to 1 is the new ratio between whom? Between B and C. And gaining ratio is what? Gaining ratio is 6 is to 3 means 2 is to 1 is the gaining ratio. This is the gaining ratio between B and C. Gaining ratio is 2 is to 1 and new ratio is 3 is to 1.